When I look at what's happening with the world's major central banks right now, the word that comes to my mind isn't crisis, and it's drift. A slow, almost imperceptible drift away from the coordination that has underpinned global economic stability for decades. The Federal Reserve held rates steady through most of 2025, even as inflation pressures mounted from tariff policies. The European Central Bank moved aggressively, cutting rates from their 4% peak to 2% by September. Meanwhile, the Bank of Japan sits at 0.5%, methodically raising rates from near zero territory while the others debate their next moves. On the surface, this looks like three central banks responding to their domestic conditions. Dig deeper, and you see something more troubling. What we're witnessing isn't just policy divergence, it's the emergence of what I call monetary nationalism. Each central bank increasingly views its mandate through a purely domestic lens, as if the global economy were still organized around closed national systems rather than the interconnected web of trade, finance, and technology that actually exists today. We're witnessing the largest coordination breakdown between major monetary authorities since the early 1970s. And if you remember that period, you know how it ended. Let me walk you through what's really happening here because the implications stretch far beyond interest rate differentials. We're talking about the architecture of global finance itself. Chair Powell's recent statement captures the dilemma perfectly. We went on hold when we saw the size of tariffs, he said, and essentially all inflation forecasts for the United States went up materially as a consequence. This isn't just monetary policy. It's monetary policy held hostage by trade policy. The Fed, supposedly independent, finding itself boxed in by fiscal decisions it cannot control. The irony here runs deeper than most observers realize. The Federal Reserve was created in 1913 precisely to insulate monetary policy from political pressure. The whole architecture, regional banks, staggered board terms, dual mandate, was designed to prevent exactly this kind of policy capture. Yet, here we are, with the world's most powerful central bank essentially admitting that its decisions are constrained by tariff policies it had no role in shaping. This represents a fundamental shift in how central bank independence operates in practice. It's one thing to maintain independence from congressional pressure or partisan politics. It's another thing entirely to maintain independence when fiscal policies create direct inflationary pressures that monetary policy must somehow address without undermining their own institutional credibility. But here's where it gets interesting. While Powell hesitates, ECB President Lagarde has been cutting rates almost mechanically, bringing the Eurozone's deposit rate down to 2% as growth forecasts dim. The logic seems straightforward. Europe faces recession risk, so monetary stimulus makes sense, except the Eurozone is dealing with the same trade uncertainty as everyone else, the same energy price volatility, the same global supply chain disruptions. What explains such divergent approaches to fundamentally similar problems? The answer lies in something economists rarely discuss publicly: the breakdown of informal coordination mechanisms that have guided monetary policy for 40 years. Since the Plaza Accord of 1985, major central banks have operated within an unspoken framework of mutual consultation. Not formal agreements, mind you, but a recognition that their actions ripple across borders in ways that can either stabilize or destabilize the global system. That framework is fracturing. Consider Japan's position in this puzzle. The Bank of Japan has raised rates three times since 2024, bringing them to 0.5%, still the lowest among major economies, but moving steadily upward while others debate direction. Governor Ueda's logic is compelling. After decades of deflation, Japan finally has sustained inflation above 2%. Why wouldn't they normalize policy? But there's a deeper story here about Japan's monetary policy evolution that few are discussing. For 30 years, the Bank of Japan served as the world's provider of ultra-cheap capital. Japanese banks, pension funds, and insurance companies exported savings globally, financing everything from U.S. Treasury purchases to European corporate bonds to emerging market infrastructure. This carry trade became so fundamental to global finance that many investors forgot it was a byproduct of Japan's domestic economic problems, not a permanent feature of the international system. Now, as Japan normalizes, that capital export machine is shifting into reverse. The implications ripple far beyond exchange rate movements. When Japanese investors start demanding higher returns at home, they withdraw capital from foreign markets. That withdrawal shows up as pressure on everything from U.S. municipal bond markets to European peripheral debt to emerging market currencies. But timing matters in monetary policy. When the Fed delays rate cuts due to tariff uncertainty, when the ECB accelerates them due to growth concerns, Japan's gradual normalization creates currency tensions that didn't exist in previous cycles. The yen's volatility isn't just affecting Japanese exports, it's creating arbitrage opportunities that distort capital flows across all three currency zones. Let me put this in perspective with a historical parallel that should make us all uncomfortable. In 1971, the United States unilaterally abandoned the Bretton Woods system, partly because coordinating monetary policy across major economies had become too cumbersome. President Nixon's Treasury Secretary John Connally famously told European finance ministers, "The dollar is our currency, but it's your problem." What followed was a decade of currency instability, inflation surges, and ultimately the most serious economic crisis since the 1930s. We're not there yet, but we're moving in that direction. The mechanics of how this happens are worth understanding because they're already in motion. When central banks pursue divergent policies without coordination, they create what economists call policy spillovers, unintended consequences that ricochet through the global financial system. Start with exchange rates. The Fed's cautious stance, combined with ongoing fiscal expansion and tariff policies, should theoretically strengthen the dollar. But uncertainty about future Fed actions creates volatility that undermines that strength. Meanwhile, the ECB's aggressive easing weakens the euro, but not in a predictable way that helps European exports because everyone knows the cuts are driven by weakness, not strategy. Japan sits in the middle, trying to normalize policy while both of its major trading partners send mixed signals. The result? Currency swings that reflect not economic fundamentals but policy uncertainty. Now, layer in capital flows. International investors face an unprecedented situation. Three major economies pursuing monetary policies that seem almost designed to confuse rather than clarify future direction. Money flows not toward the highest returns, but toward the least uncertain outcomes, except there aren't any. This is where the comparison to the 1970s becomes truly unsettling. Back then, policy divergence emerged from different national priorities. The US fighting inflation, Europe focused on employment, Japan managing energy shocks. Today's divergence stems from something more basic, an inability to agree on what the problems actually are. The Fed sees tariff induced inflation as a constraint on policy. The ECB sees trade war fallout as a reason for stimulus. Japan sees finally escaping deflation as justification for gradual normalization. All three perspectives have merit. The problem is that acting on all three simultaneously creates contradictions that markets cannot price effectively. Think about it from a business perspective. If you're running a multinational corporation, how do you plan investment strategies when the three largest economies are signaling completely different views about future economic conditions? The Fed's hesitation suggests they expect inflation pressures. The ECB's easing suggests they expect recession. Japan's tightening suggests they expect continued growth with stable prices. Someone has to be wrong, probably all three. The real problem for businesses isn't just uncertainty, it's contradictory uncertainty. A normal business cycle creates challenges, but predictable ones. Recession means cutting costs and preserving cash. Recovery means investing in growth. Inflation means adjusting pricing strategies. But when monetary authorities can't agree on which phase we're in or where we're heading, traditional business planning becomes nearly impossible. I've been talking to executives who describe this as the planning paradox of 2025. They're simultaneously preparing for inflation, Fed signals, recession, ECB signals, and normalization, Japan signals. That means holding excess cash for uncertain times while also investing in inflation hedges, while also positioning for growth opportunities. The financial resources required to hedge against all three scenarios simultaneously are enormous and ultimately self defeating. But the real danger isn't that central banks misread economic conditions. That happens regularly, and markets adapt. The danger is that policy divergence becomes self reinforcing, creating the very instability that each bank is trying to avoid in its own jurisdiction. Here's how that feedback loop works and why it's more dangerous than previous episodes of policy divergence. Fed caution creates dollar strength that pressures emerging market currencies, forcing those central banks into defensive rate hikes that slow global growth. European central bank easing creates euro weakness that forces other European central banks into defensive positions, spreading recessionary pressures across the continent. Japanese normalization creates yen volatility that disrupts carry trades and cross border investment flows, reducing the liquidity that global markets depend on. Each response makes sense domestically. Together, they're generating the kind of financial instability that typically precedes broader economic disruption. What makes this particularly insidious is that each central bank can point to the other's policies as justification for their own actions, creating a dynamic where nobody takes responsibility for the systemic outcome. I keep thinking about something former Fed Chair Ben Bernanke wrote about the 1970s crisis. The breakdown of international monetary coordination didn't cause the decade's economic problems, but it made every other problem harder to solve. That's where we are now. Rising trade barriers, geopolitical tensions, climate related disruptions, technological displacement, all of these challenges require policy responses that work across borders. When monetary authorities can't even coordinate their basic interest rate decisions, how can they respond effectively to systemic risks? The Bank for International Settlements publishes quarterly data on central bank policy coordination, though they're diplomatic about what the numbers reveal. What I see in those reports is a steady decline in consultation frequency, agreement on policy direction, and joint communication. The mechanisms that prevented the 1970s from becoming the 1930s are atrophying. There's a particular irony here that's worth noting. All three central banks, the Fed, ECB, and Bank of Japan, have sophisticated models for predicting how their policies affect domestic economies. They publish detailed forecasts, conduct stress tests, engage in elaborate forward guidance. But when it comes to coordinating with each other, they're operating on intuition and hope. The technical term for this is beggar thy neighbor monetary policy, each central bank optimizing for domestic conditions without accounting for international spillovers. It's not malicious, it's structural. As domestic political pressures intensify, the space for international coordination shrinks, but markets don't recognize national boundaries. Capital flows, currency movements, inflation expectations, these respond to the global monetary environment, not individual central bank actions. When policy signals become contradictory, markets don't just get confused, they get unstable. We saw a preview of this in April 2025 when trade policy announcements triggered sharp volatility across equity, bond, and currency markets simultaneously. The disruption didn't last long, but it revealed something troubling. The normal circuit breakers that contain financial stress aren't working as designed when central banks send mixed signals about future policy direction. John Williams from the New York Fed touched on this in a recent speech, noting that the unexpected is always waiting in monetary policy. What he didn't say, but what the data suggests, is that policy divergence makes the unexpected more likely and more damaging when it arrives. Consider what happens if we get a genuine external shock, say a major geopolitical crisis that disrupts energy markets or a technological disruption that threatens employment across advanced economies. In previous decades, major central banks would coordinate their response, providing the kind of systematic stability that allows markets to function during stress periods. Today, the Fed would worry about tariff induced inflation constraints. The ECB would worry about European growth dynamics. Japan would worry about reversing its hard won escape from deflation. Each response would be domestically rational and internationally destabilizing. This isn't theoretical. We're already seeing it in smaller ways. Energy price volatility gets different responses depending on which central bank you ask. Labor market tightness means different things to policymakers in Washington, Frankfurt, and Tokyo. Even inflation itself, supposedly the most basic central bank concern, gets defined differently across the three systems. The erosion of coordination doesn't happen overnight. It's a gradual process, often invisible until the moment when you need coordination most and discover it's not there. We're somewhere in the middle of that process right now. What makes this particularly dangerous is that financial markets have become accustomed to coordinated monetary policy. 40 years of generally aligned central bank actions have created pricing models, risk management systems, and investment strategies that assume continued coordination. When that assumption breaks down, the adjustment process can be sharp and unpredictable. If there's a silver lining to this analysis, it's that policy divergence is a choice, not an inevitability. The mechanisms for coordination still exist: G7 meetings, Bank for International Settlements forums, bilateral consultations between central bank governors. What's missing is the political will to use them effectively. The technical infrastructure for coordination has actually improved since the 1970s. Central banks share data in real time, model each other's economies with sophisticated tools, and maintain direct communication channels that previous generations could only dream of. The problem isn't informational, it's institutional. Each central bank faces domestic political pressures that make international coordination appear costly in the short term, even when it's essential for long term stability. But political will in monetary policy tends to emerge only after crisis, not before. By then, the costs of coordination failure have already been paid, usually by the people who can least afford them. The lesson from previous episodes, whether it's the 1930s, the 1970s, or 2008, is always the same. Coordination is cheaper than crisis, but crisis is often what it takes to make coordination politically possible. As I watch Powell, Lagarde, and Ueda navigate their respective domestic pressures, I see three competent professionals trying to do difficult jobs under unprecedented constraints. I don't question their intentions or their capabilities. What I question is whether good intentions and technical competence are sufficient when the system itself is pulling in different directions. And what I worry about is that we're running an experiment in monetary policy independence that nobody designed, nobody controls, and nobody fully understands. The next few months will be telling. If global growth continues to slow, if trade tensions escalate further, if financial volatility increases, we'll find out whether major central banks can rediscover the coordination that has underpinned economic stability for 4 decades, or whether we're about to learn once again why monetary policy without coordination tends to end badly for everyone involved.